Hey guys, Pup of Wall Street, and today we're going to be looking at my top three favorite monthly paying dividend stocks and ETFs. Now, we're going to look at this definition of passive income, which has a lot to do with dividends. It's just income that you get with little to no effort in order to maintain. So what we're going to be doing is the method we'll be using is making our money work for us using dividends. And the definition of dividend is right here. It's a sum of money paid regularly by a company to its shareholders out of its profits. So say you own a share of Coca-Cola, they give you some of their earnings that they made that quarter. A quarter happens 4 times a year, every 3 months. Now this says typically quarterly right here, but we're going to be looking at the ones that pay monthly. So every month you get a payment from these companies or ETFs. Now we're going to hop straight into the first one, which is SPHD. Now as you can see, they consistently grow in capital appreciation over time. So what that means is if you can buy it here for $28 and you could sell it here for $33, making that profit. You make a $5 profit right there. Now, that's not what we're concerned about when we buy these though. We're concerned about right here, the dividend yield. So for every $100 you invest in this company, you get $5.62 a year. Now, they pay about 15 cents per share every month. They're priced at $33.80 per share. They do have a high expense ratio of 0.3%, but I think that's justified by the constant growth, the high yield, and the monthly payments. We're going to look at what's inside of this ETF, what stocks, because remember, an ETF is a basket of stocks. So you don't have to pick and choose, you just buy the ETF. Now we can see Williams Companies Incorporated, Iron Mountain Incorporated, Altria Group, Gilead Sciences, Philip Morris, Dominion Energy, General Mills, and then AT&T, Progressive International Business Machines. So we have Altria Group, they're pretty popular. Gilead Sciences, Philip Morris, they make cigarettes and cigars and tobacco products. Dominion Energy, Warren Buffett actually just bought a big portion of them. General Mills, you've probably eaten their cereal. AT&T, a lot of people use their cell service. And Progressive, you've had to see Flow in a Progressive commercial. All right. So if we go back to their summary, you could see they still haven't recovered from the pandemic. From about $44, they're still at $33. So I think they're still undervalued, and I think this is a great time to buy them. Now, onto our second stock. We can see that this is Main Street Capital. They also grow over time in capital appreciation. You buy here at $10, you can sell it here at $30, make that $20 profit. That's what it is. But again, we're focused on this, the dividend yield of 8.12%. So for every $100 you invest, you get $8.12 back every year, which I think is a lot. This is one of the higher dividend yields. You have to watch out because they do have a lot of debt to asset that hasn't been going down, but their revenue has been increasing year over year. They pay about 20 cents per share per month, which is a high amount. They say it's overvalued. I still think it's undervalued. You can see it's high. It was at around $43. Now it's at $30. I still think it's a good buy. They are a REIT, which is a real estate investment trust, which just means that they have to pay out a certain amount of their profit to their shareholders. Now we go on to our last one, which is Realty Income Corporation. Realty Income is priced at $60.55 right now. Like the other ones, they haven't recovered from the pandemic completely. It was at $82 before. It's still at $60. Totally undervalued. Does have a lower dividend yield than the other ones, but has faster growth, and their earnings per share continues to go up quarter after quarter, which I find amazing. Now, there's one concern I have is that most of their buildings that they rent out to tenants. So what they do is they buy a building and then they rent it out to someone, and they get money out of that, and most of that money they have to pay to us, their shareholders. So most of them are like commercial real estate. So Walgreens, Walmart, Home Depot, these people, where are they going to get their buildings to sell it to their product? And they rent it from people like Realty Income. They pay out their monthly 23 cents a share, roughly, and they do grow over time. I love them. They're undervalued. This is a great time to buy them. I'm trying to buy more of this, but I do want to upgrade positions on Main Street Capital, which is the second one, sorry. So what I would recommend doing is using the snowball effect or compound interest. So say you make 23 cents a share on realty income every month. The next year, now you're making 24 cents because that 23 cents every month you put back into the company. And still, if you're older and you don't have the time to take advantage of compound interest, I totally recommend SPHD because you can just throw your money there and then know that you'll get a consistent income every single month. Because they are an ETF, they're much safer than Main Street Capital and Realty Income. But I love them all. And one of my favorite parts about them is every single year they increase their dividend. So every year Realty Income increases it by about 0.5 cents to 1 cent. Now that doesn't sound like a lot, but every month because they pay out every month, that is a lot. So next year they could be paying out 24 cents. And then in 12 years, now they could be paying out 36 cents a share, which is 50% more than what you bought it at. Also look at the capital appreciation. I love all three of these. I totally recommend them, but you have to remember I am not a financial advisor. Please do your own research. You can't just watch my videos and go and buy everything I mention. Thanks for watching. I hope you enjoyed, and I'll see you guys next time.